Welcome back to UK Property Scale Up, the podcast dedicated to helping you scale your property business and make smarter investment decisions. Today, we have a fantastic guest who brings a wealth of experience from the front lines of property investment. Joining us is Cole Grimshaw, a seasoned property investment broker with years of B2B sales experience. Cole's specialized in helping high-end investors identifying suitable properties, negotiating deals, and develop sound investment strategies, guiding them beyond common misconceptions in the property market. Welcome to the show. It's great to have you here.
Thanks for having me.
Cole, we had a great pre-call, and I am really excited to dive into our topic today, navigating the current investment property landscape and securing profitable deals. For our listeners, let's start by setting the stage from your perspective. What does the current UK investment property landscape look like right now? And what are the key trends or shifts should be aware of?
Yeah, so obviously politically, there's a lot of changes going on in terms of things like the Renters' Right Bill. Every time the budget's been announced, there's been potential changes on stamp duty or property taxes that are involved, and taxes in general, which is things that I'm seeing are influencing investors' decisions in terms of making a sound investment. In terms of when the last budget was announced, which was just the last quarter of last year, things were starting to slow down. A lot of people were waiting until the budget was announced before making any decisions or putting any offers forward. Afterwards, they were going to wait until next year. So it's definitely slowed down towards the end of the year for, I would probably say for your more novice to apprentice and like level investor. So, people that are just starting their portfolio, people with, 10 properties and under is what I would consider quite a new investor to the market. So these type of guys or women are that they were slowing down. They were kind of waiting on things to happen. So waiting on the budget being announced, waiting on changes coming into place. Whereas the more experienced investors were the ones that were actually proceeding with deals, because I think that the smart investors they know that when budgets come out or when any change happens, when the sea isn't smooth, people are very quick to jump overboard and they start to panic. These investors start to panic. Oh, I don't want to invest in case I lose my money or in case this happens. And then sellers were actually starting to panic as well. With the changes coming out, they're thinking, right, I should probably just cash up the now. I'll cash up the now. I'll sell off my portfolio. And the smart investors, the experienced investors, are capitalizing on this, and they're getting properties for with prices with a haircut. Essentially, they're getting a discounted deal because they know that investors that aren't as well informed as them are going to quit the market, going to exit. Now, in terms of the run up to Christmas is when things will start to slow down. As you can imagine, most people slow down in terms of their occupation. They slow down. They go maybe have a break over the Christmas period before they turn in the new year. The experienced investors, I was still doing deals up until Christmas Eve. Although there was no lawyers around and all that at that point, and I had to wait a few days until after Boxing Day to get, memorandums of sale issued, but there were still people doing deals. But these were the smart, experienced investors who just don't switch on. Come turn of the new year, it's been very busy. Coming into to the second quarter, quite soon, it's starting to gradually slow down. But I think, it really depends. I think that the market's still booming and there's still loads of good deals. I think sellers are panicking just now. And I'd say it's more of a buyer's market. With all the changes coming into play this year, sellers are looking to start cashing out now. And investors who are smart enough and ready to bite the bullet, who have a good teams behind them, are the ones picking up these deals. So I wouldn't read into it too much. You see a lot of people online that are saying, oh, it's a bad time to invest. It's this time to invest. I don't think there's ever a bad time really to invest. You'll know yourself about in 2023 to 2024, we had the rent freezes. So people couldn't, you could buy a property with a tenant in it and you couldn't increase the rent to 3%, or you could buy it vacant, put a tenant in it, and you still couldn't increase the rent by more than 3% annually. So, and even then people were still getting fantastic deals. So I think there's an old saying, it's one man's trash is another man's treasure. So I think that sellers that are, cashing out just now because they're panicked about change and they think it's going to, influence the market. If you're a clever investor, this is the time to start, open up your war chest and start putting your money where your mouth is and start finding some deals, start dealing with some brokers, start dealing with agents, and get a few properties under your belt.
That is a really comprehensive overview. You mentioned, that the impact of renters' rights bill, while it's caused some panic, you noticed that the experienced investors actually found opportunities in this. Yeah.
Yes.
Based on that, are there any opportunity for acquiring tenanted properties at reduced price currently on the market?
Yes, certainly. I mean, not just tenanted properties. I mean, any type of property. To be honest with you, you can. What I'm starting to find is the the type of, and again, this question really depends on the people that you're dealing with. If you're dealing with a local agent, they're not geared up to sell investment properties. They're selling a lot of time vacant properties that have been lived in for the last 10 to 15 years by a residential buyer. So it really depends. That question can have two answers. I think if you're dealing with an agent that's dealing with an investor, so an investor that owns 10 to 15 properties that's selling their portfolio, that's completely different. Because at that point, with the changes coming into place, these investors who've been investing for the last 30 to 40 years, this is their retirement pot 9 times out of 10. So this is the money they're using to live off of once they stop working. So for them, they're a lot more quick to pull the trigger in terms of, right, changes are coming into place now. I should start cashing out because they don't want to run the risk of holding it for another year, holding it for another 2 years, and then more changes come into place. The value depreciates, or issues happen, or the place, loads of things can happen. I think I think to answer the question then, really, you can, yeah, you can pick up deals below the market value, tenanted or not, if you're working with the right agent. As I was saying to you in our pre-call, I think, one of the deals that I'd managed to get done for one of my clients was an off-market property. The valuation was done at 220,000. It was a 3-bed semi-detached house over in Helensburgh. The seller had loads of personal issues in terms of they're going through a divorce and they needed to get this property done. Um, we had an offer at 50k and they took it. So that buyer bought it cash for £50,000, refinanced £170,000 out of the deal, and walked away with the amount of money that he can put down, is 25% on four, five, six different other properties to invest. So you definitely can get fantastic deals. But the important thing is that even if you've got 10, 15 properties, is you're still inexperienced compared to people that have 70 to 100 that I deal with. So you need to kind of, be humble and look for a reputable agent and build a proper relationship rather than just doing one deal here with one agent, one deal here with another agent. And I was saying this to you earlier on, Zakir, that guy that managed to get that deal, the first property he bought, he paid over market value for it. So he
Uh,
never got like a great deal. He never got a great deal to start with, but he knew the value of the property would rise very quickly. He knew there was refurb work that he could do. And because I knew that he was a good client with a good strategy in place, and we had that mutual trust, I knew as soon as this deal came across my desk, he was the guy I was going to call. And within 15 minutes, he paid a deposit to secure it off the market, and it
mm,
completed within 2 weeks. So it's really about the people that you know.
it's the people you know. That's a great example. Now let's talk about securing profitable deals. Yeah, you often see investors paying over market value and struggling to recycle capital efficiently. What are your top strategies for identifying truly profitable deals? What should investor be looking for in terms of risks, home reports, or properties that are genuinely below market value?
Mhm. I mean, this is always a difficult one because no one has a crystal ball, so no one knows if the property market's going to go up, it's going to go down. But there's definitely ways that you can tell with, and again, it's not always specific to the property. I think ideally you would want a home report or a level 2 survey done before completion. But again, that can cause, if you're halfway through completion by the time the seller can grant you access, and the property valuation you've overpaid for it, you want to pull out, you could be liable to solicitor fees, which isn't ideal. So really, if it was me, right, and I was trying to find a deal below market value, I would be looking at the area. I'd be
Mhm.
looking at, right, what's the council doing? Is there gentrification going on in the area? Is there new schools being built? Is there new hospitals being built? What's the general upkeep? What's the caliber of tenant that I'm dealing with as well? So I would phone around. I've done this before for other clients. I'll phone around other properties on the market at similar prices, and I'll say, okay, well, why is your seller look to sell? That's a key question that people tend not to ask. Why the seller's actually looking to offload the property? Because if you're an investor, right, you've identified the property as a good investment for you. So the first question that you should be on your mind: if this investment's so good, why is this guy selling it?
Why? Yeah.
And most people don't think like that. So I'd be phoning Muller agents and I'd be finding out, okay, why is this? Why is your seller look to sell? And if there's a common, and a lot of the time there'll be a pattern, there'll be a common theme. It could just be that that the area is not as good, or there's been a lot of break-ins, there's a crime rate's really high. At that point, then even if you get it below market value, you're not really going to see much return. The capital appreciation isn't going to be that good over the upcoming years. Tools like Rightmove as well actually tell you if you go into sold prices, if you pop in the postcode, it will tell you for the last 10 years what the average sold price has been, it'll tell you what the peak is. So you can get a rough idea that way. Ideally though, you're wanting to look at the survey. And again, if you're dealing with an agent like myself, uh, I'll always go through all the relevant information prior to before we even discuss price. But if you're doing it through an estate agent or anything like that, the key questions you need to be asking and need to be getting a better understanding on is the seller's standpoint for selling, work that needs done on the property, the tenant information, what's their payment history been like. And don't just take an agent's word for it, request rental statements. They should have that on their file. A lot of the time I'll send over tenancy agreements redacted and rental statements redacted to investors to prove that this tenant's employed, this tenant's paying the correct amount on the agreement. I would also double check things like the compliance is in place, gas safety, EICR, that kind of idea. Again, just because something's below the market value doesn't mean it's a good deal. There could be a reason why this seller is looking to take a haircut on the price. So to avoid that, you really need to make sure you're working with a reputable agent, one that can provide the information. Two, you need to make sure you're doing your correct information and correct research and due diligence into the area.
Being strategic and analytical, not just reactive. This leads perfectly into avoiding common investors' mistake.
Yes.
What are some of the typical errors, and how can our listeners avoid them during the acquisition process?
Yeah, definitely. The first one that pops in my head straight away is do not get emotionally attached. Just because it's got four walls, four windows, and a door doesn't mean that you're going to live in this property. Just because it's a house does not mean that you're never going to see the inside of this place realistically. Most likely, I've had investors that have bought properties and had them for 15 years and they've never stepped inside it once. You need to take the emotion out of it. It's a house, yes, but you're not living there. I find it so common with investors that they get so emotionally attached and it drags them down into the weeds of nitpicking details which isn't required. Things like the carpets and the curtains will throw an investor off making a fantastic investment. The property I've genuinely had investors who have identified an investment. I've negotiated them a deal with £20,000 worth of instant equity into it. The tenant's paying the rent at like a 10% net return on your investment. The deal stacks up on paper for the plan, but because the curtains, look shoddy and the wallpaper's got rips in it, they're turning around going, no, I'm not ready to proceed. I can't do that. So you need to really take the emotion out of it. And you need to understand, I think that's something that, again, most agents won't probably say to an investor, but you will have to spend money on property. That is the bottom line of it. You need to understand that you're not going to buy an investment property and you don't only have to do work to it in the next 5 years, unless you're buying a new build, but new builds depreciate very quickly. If you're buying a property, you're going to have to factor in a few £1,000s a year, probably a maintenance dependent on the property. And I think you need to firstly, one, take the emotion out of it and understand that the standard of living to some people isn't the same standard to you. There's a reason you're an investor that's got the funds to buy their second home, and there's a reason there's someone that's a tenant. Do you know what I mean? So you need to understand that and take the emotion out of it. I'd say number two would be, I see a lot of investors, again, looking at the condition of a property seems to be something that really drags people down. Or the area of the property is another very common mistake that I see investors make. For example, when I'm dealing with an investor on a call, Zakir, okay, and let's say they've inquired on a property down in the Leeds, and I'll say, okay, what did you like about the property? For me, what's a massive red flag is if their first answer is area and condition. That's the two biggest red flags ever. Because at the end of the day, you're making an investment. The first thing that you should say that you liked about the property was the money, or the fact that it's
Yeah.
making great returns. But you'd be surprised at the amount of common investors who make these common mistakes that they get so tied into wanting a property in perfect condition in the perfect area. It's stupid. It's really stupid. The experienced investors, genuinely, I've got a multitude of clients who all live in London and
Hmm.
they buy properties in Scotland. And they will never come up to Scotland to see these properties. They don't view them. They don't care. But they see the fact that they're getting a 12% yield and they only need to spend 30 grand and they go, sound. Happy days. I'll pay that.
It is, yeah. Mm.
It's to kind of summarise here, investors need to take if you're a new investor, and for me, as I said earlier, a new investor to be someone, 10 to 15 properties or below, that you're still inexperienced in my books. You need to really understand, you need to take the emotion out of it. You need to understand that some people's standard of living isn't the same as yours. And you need to understand that you operate a risky strategy if you invest in the one area. Just because it's next to your house does not mean it's going to be a good property. Okay? Because if the market crashes where you stay and you've got 5 investment properties, you're done. You're gubbed. You know what I mean? You
Yeah.
need to diversify. And as I said to you earlier on, that's what my main job is helping investors diversify. A lot of my investors are part of the Muslim community as well. Hence why sometimes I help them with properties in the Middle East as well, which I'll do privately, buying off-plan properties from developers, where you can get reputable mortgage brokers over there as well for the Muslim religion. The same in the UK as well, but a lot of investors that might have 5 properties in the local area and they want to then eventually diversify. And I think it's smart. You should have properties dotted all over.
Yeah. Yeah. This is incredibly valuable advice. It sounds like a lot of those mistakes can be mitigated, by relying on professional guidance. You strongly advocate for working with trusted brokers, agents, and chartered surveyors. Can you explain the importance of true property evaluations like level 2 survey and pre-checks reports, and how a good professional team can make all the difference in making informed decision?
Yeah, definitely. I mean, to be honest with you, though, that having a good team is also a double-edged sword, because you need to be very important. It's very important. You need to be very careful with who you take your advice from. A lot of the time, I find investors, they'll speak to me on the phone, or they'll speak to one of my colleagues, or they'll speak to an agent, and they'll run all the deal details past their mortgage broker. And my first question to them is, how many investment properties does your mortgage broker have? And the answer is always none. So
None.
I'm saying, okay, so you're taking investment advice, from someone who has no clue really what they're doing. Yes, they might have some knowledge of investments and they might have helped with mortgages. Fair enough. I'm not discrediting them, but I find these people that spend £10 to £15 on mentors, who maybe have, and I've seen people spend 10, 50 to £15 on mentors who have been looking for the last 4 months on the market, and their mentor just tells them not to buy every property, and they continuously subscribe to these mentors. It's a waste of money. You need to be very, very careful. I think you need to work with the correct people like myself and my colleagues, for example. You know, we, if you're a good investor and you've got a good strategy, good mindset, and you work with us, we will work with you long term. And that doesn't just mean, you buy one property from us, I'm going to sit and spend you, 5 property listings for the next 2 weeks, and sign you up to the email list. It'll be more a case of, once the property's completed and your cash, you're actually seeing the returns. Because it's all good and well getting an offer agreed. Once we get the returns coming in, at that point, I'll then work with your second one, whether it's abroad, over in Dubai or Saudi Arabia or Doha, places like that, and you're looking for an off-plan deal, or if it's in the UK, that's fine. We'll work with you to find the right one. I think it's important that the team that I would have would be a proper blender that only specialises in buy to let. not a bank. Don't go to NatWest for your mortgage for a buy-to-let. It makes no sense. Go to a large broker and have someone that's reputable and that specialises in buy-to-let, because in NatWest I've seen mortgages be refused for the most stupidest reasons, to be honest with you. So make sure sorry about that. Make sure you've got a proper broker in place, as well as having a proper agent to find you deals. Lastly, I'd have a proper good conveyancer. As well, someone that's going to be on the ball for you, that can work to the time frame you want to work with, and that you can work to the sales, the deadline as well. I think in terms of surveyors and things like that, when it comes to buy it, if you have like a proper good lender or a proper good mortgage broker, they will be able to send a lender on the on your behalf. So they'll have people in house that they use, which is going to be, at the end of the day, a mortgage broker wants this deal to go through because they get paid a commission on the mortgage.
Yeah.
So they'll have good surveyors that can go out and give you a proper valuation with non-bias, or slightly in your favour, I guess, as well. So that would be the kind of people I would surround myself with. I wouldn't bother with property mentors. I wouldn't bother with, these courses that people spend thousands of pounds on to educate yourself.
Yes.
I think if you're a new investor, speak to a proper agent. The amount of time I dedicate with my clients is 40 to an hour, 40 minutes to an hour on the phone, just the first call. And that's properly understanding why you're investing. It's educating you and walking you through the process. It's not a case of you speak to me, I ask for an offer from you, and then I'll come back a week later and tell you yes or no. It's properly guided through the entire process to make sure that the property you want is the right one for you.
It's clear that building the trust network is paramount. Um, what is the core strategy or guidance you provide that enabled investors such a rapid and successful growth, and how can our listeners apply those principles to structure deals for success and ensure efficient capital recycling?
Okay, I would say you need to act. Action. You need to be very proactive. If you want to get these deals that every other investor wants, you need to be fast. So
Yes.
you can't dilly-dally, you can't sit and stare at photos all day and send it off to your friend who's got one property, and send it off to your brother and your mum and your sister and your dog and your auntie and your cousin. You need to act. You need to be on the phone to as many, to your team. You need to be on the phone to someone like myself, your broker, firstly. Get their opinion, their advice, identify the deal. I'd also still do my own due diligence. I'm not just saying rely on every word that comes from my mouth. I would still do your own due diligence, because at the end of the day, I could make a mistake that I've not got. But that is far and few between because of the amount of research that I do myself. But I would still call, as I said to you earlier on, if I'm looking at a property, right, let's say it's in Leeds, again, just for an example. The average sold price in the area is 100k. Its offers over 80,000, and there's 4 other properties up for similar prices. I'd be phoning the other estate agencies or brokers, and I'd be asking them what's the seller stance, why are they selling. I'd also be googling the postcode for looking at, and there's different websites like next door. There's also a text app called In Your Area, which tells you what the crime rates are, the average house price sales as well, why people are selling, loads of things like that. So you can actually get the people's opinion. Things that I'll be using tools like this to identify. Okay, is there room for growth here? Is there things happening in this area that's going to cause my money to grow? Because if you look at this, it's all good having a property that's generating your 10% yield. You may be making £400-500 a month in profit, but your real money is going to be made in your capital gains. And I think it's important. You need to identify an area where growth is critical. For example, I had an investor years ago that bought a property over in the West End of Glasgow. And there was growth there to turn it into, it was a 2-bed, but there was growth to turn it into a 3-bed. I think he bought it for like 120. It's now worth over 240. 230, I believe, something around that ballpark last time I spoke to him. Within only a couple of years of time, do you know what I mean? So that's more than doubled his money within 2 to 3 years. But again, the area that we bought it in was it's just outside the West End of Glasgow. But in that area, there was about 3 different apartment complexes being built in that time. So he knew as soon as they were built, rental prices were going to go up, the demand was going to go up. So it's being clever and looking into the actual area yourself and understanding, okay, is there going to be growth? And of course, if you can get a property below the market value, then it just sweetens the deal even more. I think ideally you want to be trying to get your money back out after 6 months so you can go and do the same strategy again. But where I think investors, where the bottleneck is with investors, is because they're so tied down to one area. You're constantly looking for a needle in a haystack. Whereas the smart investors who have loads of properties are the ones that are looking all over the UK, and they can identify free properties that have growth for capital gains that they can recycle their cash, and they can just go buy all free. Whereas someone like a novice investor who's stuck in Leeds looking for the same fucking 2-bedroom house, it makes it really difficult.
Yeah. Cole, this has been an incredibly insightful conversation. You have given our listeners a roadmap for navigating the current investment property landscape and securing profitable deals. Thank you for sharing your experience on avoiding common pitfalls, the value of professional guidance, and understanding market dynamics. Before we wrap up the official podcast segment, I want to ask something that often comes up with our audience. For many property investors and developers, the biggest challenge isn't necessarily knowing what to do, but consistently executing on it, particularly when it comes to consistently finding those profitable deals and building out their professional network. If you have a if you had a magic wand and could solve just one persistent bottleneck for property investors who are struggling to consistently find and securing those below market value deals, what would that one thing be?
I would say have an open mind. I think too many investors have a closed mind attitude because the typical investor is someone that, if you have money to invest, you probably have a very good job. You've got a lot of good income. You probably run a business. So I think you automatically think you're the expert. You think you can advise. You think you know what you're doing because you have a couple of properties. If I could wave a magic wand, it would be lose the arrogance and work with people that know what they're doing. Like, I know for a fact that the people that I deal with that have 100 odd properties, they're not arrogant at all. They barely talk about how much properties they've got. They're open to my guidance. People that have 10 to 15 properties, though, they seem to think that they are Warren Buffett, and they're not open to any sort of guidance. So my magic wand would be, if you're an investor, experienced or new, and you're genuinely wanting to scale a property portfolio, then please lose your ego and lose your arrogance and come onto the phone with me with an open mind and understand that we're actually here to help you. At the end of the day, we're here to help you get the property and get it at the best price possible. But we can't do that if you've got these limited beliefs of the traditional way of the traditional model way of buying a property.
That's that's a very clear focus. Can you expand a little on why people are arrogant and they got ego, especially the investors, and they are
Yeah.
they got a close mind attitude. um, it's such a significant challenge for the broker right now. Can you please expand a little bit?
Yeah, definitely. I think I would say it's a challenge for me to deal with. To be fair, I'm very good at winning people on eventually, but I don't get everyone. I think to answer your question, not everyone has money to invest in the UK. Not anyone can go and buy a second home. Some people can't even buy their own first home. So when it comes to people that have the amount of money to buy a second property solely for investment, 9 times out of 10 they're going to be in the top 15% of earners in the UK, maybe 20% of earners in the UK, depending on the property value. So these people that they already come into this with a bit of ego because they before they've even got a property, they're calling themselves an investor. they're already thinking about the outcome, which is good to an extent. They're already thinking about retirement, kicking back on a beach with a pina colada with the wife. They're already thinking about retirement. They're already thinking about how much money this property is going to make them. They're already thinking about what their strategy is. When really they need to. It's like going into anything new. If you, I don't know if you have an interest in sports, Zakir, but when you start playing football, for example, at a young age, you don't go in thinking, right, I'm going to be good. I'm not going to listen to the coaches, and I'm just going to do my own thing, and I'll be fine because I know what I'm doing. I've watched a football match before, right? Whereas some investors go, I've watched a podcast, I know what I'm doing now. I'm just going to ignore the broker's advice. It's like, no, hold on, that's not how it works. I think because these people have a large amount of money saved up, and these guys are, as I said, the type of people that we're dealing with are business owners who have egos, and rightly so. If you're a business owner, you've got a business and you're making money, so you should. Fair enough. But when it comes to things that you're not clued up on, then it makes no sense. But you need to humble yourself a wee bit, and that's the hard. I'm being quite harsh when I'm saying that, but it's very, very, very true.
Cole, thank you so much for a valuable discussion. I know our listeners will get a tremendous amount from this episode.